Good morning and welcome to Member Focus Monday. I'm Christina Schaefer, Director of Social Media for HAR, and I'm joined this morning by a returning guest, and we're so happy to have him again. We have Gerald Klassen. He is a data research scientist with the Real Estate Center at Texas A&M University, as you can see with his maroon shirt on this morning. Welcome to the program, Gerald.
Hey, Christina, good to see you.
It's good to see you too, and I'm really excited that you were able to join us again today. We've had you on a couple times in the past because we have a lot of data to share. Gerald's provided some slides for us that we'll share with you all towards the end of the program as well. But Gerald, before we dive into everything about the market that everybody needs to know, will you just tell us a little bit about yourself, who you are, and what you do at the Real Estate Center?
Sure. So I am the research data scientist at the Real Estate Center. Uh, Early in my career, I started working at USAA. There, I was responsible for managing the investment accounting system and producing analytics for their 14 billion insurance portfolio. One of the things I did there was to lead a project in our securities lending program to to raise $1 billion liquidity by borrowing against securities. After that, I went to work in 2002 at MetWest Securities in Los Angeles, a very successful securities lending firm with about 55 billion in assets under management. And you may be asking, why the heck am I talking about securities lending? What is it, and why am I talking about it? Well, this is going to come up in our discussion when we talk about the trends and the things that I'm seeing in the market right now, because a lot of it is securities lending related. Um, the best way to describe it, I don't know. Did you ever see the movie The Big Short or Margin Call?
No,
Back about You didn't see those
I
movies?
didn't see them,
Well,
but I'll put them on my list.
put them on your list. They're great because they really captured what happened in 2007, 2008.
Mm.
And there was a lot of lending going on against securities, and firms like Front Point and Sign Capital would borrow securities to short, and then we would take the cash collateral and lend it to Morgan Stanley and the big, Deutsche Bank, Lehman Brothers, Bear Stearns. And when the value of the collateral started getting questionable, we started pulling cash away from those big brokers. Now, think about what's going on these days with stock markets and the cryptocurrency and all that increase in
Hmm.
assets. A lot of people have been borrowing, just like we used to do in the securities lending business. They've been borrowing to make purchases of houses and other assets. And so there's a lot of similarities, I think, from what I was looking at back in 2007, 2008 to what's going on today. And so we'll talk a little bit more about that when we talk about trends. Um, in 2008, when everything was blowing up in the securities industry, I made the jump over to the Real Estate Center and went to work there, working with Mark Dotzer to figure out what was going on in the financial system and how to break the log jam of foreclosures. Um, and I left in 2012 to go for a quick consulting uh, gig with the securities lending guys I used to work for, but then came back in 2014, and that's when I started working on the data warehouse that we use today to produce the statistics for
Hmm.
HAR and for all the boards. And that's what I really am looking forward to talking about, the data and the things that I'm seeing, because I've just put together some new data sets to analyze these new listings and active listings. And I think there's some pretty interesting things going on, and I'm going to love to get some feedback from your members about what exactly is coming into the market. And so, anyway, so
Yeah.
little long-winded, but that's I think there's a lot of similarities, a lot more similarities to the market today back to 2007 than
Mm.
what people people really think. So we'll get into that.
Yeah, we'll get into that. Let's talk about home prices because you have an interesting perspective on how home prices reached the level they're at today. Can you share that with us?
Yeah. So the first thing I like to do when I talk about home prices, I'd like to ask people, what happens to home prices when borrowers get more money to spend, right? And realtors are fantastic. They know the answer to that question. When people get more money to spend, home prices go up.
Mm-hmm.
And so what I did is I looked back to 2007, 2008. So if you can throw up that first slide. Do you remember that first time homebuyer tax credit?
Mm-hmm.
That was $8,000. Started off as a repayable loan, but then just went to an $8,000 tax credit. Well, you can see here that prices, and this is based on our home price index. So this is a repeat home sale index that shows the low price homes, mid price, and high price. And what you can see here is that as things were melting down in the housing market and in the financial system, home prices were falling and went negative. And then that first time tax credit program came into existence, and you can see it halted the decline and actually caused price growth to turn positive briefly. And it started, and if you look real closely, that blue line turned up first, and then the orange line. So the low priced homes turned up first. So those first time buyers were using that tax credit to bid up prices at the low tier. Then the mid price tier turned up as those sellers to the first time buyers used their gain to buy to move up into the mid tier, and then the mid tier folks moved up into the high tier as those prices as prices were increasing. So it was like
Mm-hmm.
a domino effect that started at the low end of the market and worked up to the high end of the market. As soon as the cash quit flowing, prices went negative, started falling again on a year over year basis before they finally in 2011, 2012 turned positive. So this is real good evidence that when you give people more cash to spend, home
Mm-hmm.
prices go up. So then I started looking and thinking through what just happened in 2020 and 2021. Price appreciation has been crazy. So let's look at this next analysis, where what I did is I did a scenario where I compared um, the home prices, or the purchasing power of buyers, first time buyers and repeat buyers. So what happened was in the using if mortgage rates would have stayed at about 3.94%, the average for 2020 or 2019, if they would have stayed there in 2020 and 2021, home prices would not have risen as much. But what I looked at is the rate actually dropped to 3.11%, the mortgage rate, and then it dropped down to 2.96% in 2021. Well, when you look at the increase in purchasing power just by the drop in the mortgage rate, and then I made another assumption that the first time buyers in 2020 used about $3,000 of their stimulus money towards a down payment. Look at the increase in purchasing power across the four MSAs
Mm-hmm.
in Texas. There was, for the first time buyers who were using, you got the benefit of the mortgage rate and had the extra 3,000. There was an increase in purchasing power for them of 10.8%. When you compare that to the median price appreciation, right? The statistics that we produced for you guys and for all the boards, look how close that increase in purchasing power was to both the reported statistics and our home price index. So you can say that a lot of price increase, price appreciation in homes in 2020 was
Mm-hmm.
driven strictly by the increase in purchasing power from fiscal and monetary stimulus. When you go to 2021, it was the same thing. that increase in purchasing power was very close or explained most of the price appreciation in 2021. So, what that shows us is that the fiscal and monetary stimulus were the main drivers of home price appreciation for the last 2 years. Well, now what's happened since then? Mortgage rates have more than doubled, and there's no more fiscal stimulus. So, financial markets and monetary policy giveth, and they taketh away. So that purchasing power has dropped by even more than what it went up in 2020 and 2021. And that's the headwind that the housing market is facing right now with buyers with significantly reduced purchasing power.
Okay.
Let's talk. So, I wanted to talk about inflation a little bit. So, that next slide, right? So, you think about this for a second. The Fed started printing money in 2008 and purchasing assets, and they did about $3.5 trillion, and we had low inflation. And then in 2020, they printed a whole ton of more amount of money, and we got high inflation. So my question, the riddle is, why did we not get inflation up until 2019, but then now we have high inflation? And the answer to that is that we actually did experience a huge amount of inflation from 2008 up to 2019, but it was in home prices. It was in consumer prices because the Fed had their money cannon aimed at the housing market, buying mortgage-backed securities, which reduced the spread between mortgage-backed, for mortgages relative to treasuries, and it reduced the treasury rates, which brought down the mortgage rates. So we may not have had more expensive gasoline, food, and appliances from 2008 to 2019, but we got record high home prices. Most people think of home price growth as appreciation, but it actually, in my opinion, was inflation. And what changed in 2020 is the Federal Reserve pointed their money cannon at consumption, right? They just handed that money out to people in their bank accounts to spend on whatever. And they went out and bought a lot of appliances, RVs, and did a lot of that gave us this inflation that we're experiencing right now. And so I'll argue that we've had significant inflation since 2008. It's just first it was in the housing market, and now it's in the consumer market. And the difficulty or the challenge going forward is going to be the Fed is going to withdraw, right? Quantitative tightening. They're raising the policy rate. They're causing mortgage rates to go higher. And that is going to bring down consumer inflation, and it's going to bring down home price inflation. And so it's going to be a significant headwind for the market, for the housing market going forward. So
Gerald, what does this mean for future home price appreciation, and what does it mean for homeowners that bought during the highest level of those home prices?
Well, it's going to be a real challenge, and it really depends on how committed the Federal Reserve is to killing consumer price inflation. They seem to be very determined, and that means that the money supply is not only going, the growth is not only going to slow, but it's going to reverse. And what happens is when money supply slows or reverses, asset prices fall. Now, let's take a look at the long-term trend of home prices to household income. So this is at a national level. So you can see that from 1976 to 2001, so for 25 years, the ratio of median home price to income, traded in a range of 2.96 to 3.52. Now, that little drop that you see in before 1976, to me, is the most similar to the environment we're in right now. Back then, you had, in the 60s, you had inflation taking off, you have the Federal Reserve increasing the policy rate to try and bring down inflation, and you had the money supply growth, or the money growth, uh, uh, slowing dramatically. And what happened back then is home prices fell about 12% on a national basis, because it was just more difficult to get money. Mortgage rates were up and the money supply was shrinking, and home prices fell. That's very similar to our current environment today.
Mm-hmm.
Well, when you look at 2001, that first, the housing boom, when you look at that growth in money supply that happened, or growth in money for housing that happened with the underwriting, at the in the banking system, that huge supply of money pumped up that ratio. Home prices went up just over 4.2. 4.2 is a ratio of household income. And then when the bust happened, we just about went down to that long-term level. And then the Fed had their hold my beer moment and said, watch this. And they started printing money and have inflated home prices relative to income even higher. Now, if you talk about what will bring, if home prices go back down at the national level to the
Mm-hmm.
normal level of 3.5, home prices will need to fall on a national basis about 21.8% to get back to 3.52. If it goes back down to the low end of the range, 2.96, you're talking about home prices falling 34%. So I'm not saying that they are, but I'm saying if the Federal Reserve is really out, you're looking at home prices to get back into an unstimulated world. You're looking at home prices over the long term falling down to a level that could be anywhere from 21 to 34%. Now,
Oh.
people say Texas is different. Okay, so let's take a look at Texas.
You read some minds because somebody said Houston is different in the comments.
Oh, absolutely. Houston's very different. But just how different is Houston? Well, let's look. So this is Texas overall. Um, and it traded in a narrow range from 1990 to 2000. But then in 2000, what happened in 2000? We had the tech crash, right? And the Fed started, dropped the Fed funds by over 500 basis points. They dragged down mortgage rates by over 300 basis points. And that, what happened in Texas is you almost didn't see any home price decline during the tech crash. And then when the Wall Street figured out that home prices never fall, like they didn't in the tech crash, and they could start doing some crazy lending. Well, thank goodness Texas had good laws against lending, regulations regarding lending, and we didn't get the real boost in that ratio, right?
Mm-hmm.
But but then we've seen since 2008, Texans love their fiscal stimulus and their monetary stimulus just as much as the rest of the country. And home prices have taken off. And we're now at a ratio of about 4.2 price to income ratio.
Mm-hmm.
Now, if you talk about in Texas getting back to that normal range, you're talking about a decline of about 31.8% in home prices to get back to 2.89, and a decline of about 38.4% to get back to that 2.43. Okay.
Mm-hmm.
So to get back into that normal range, you're talking about prices need, and Texas wide, need to come down to anywhere from 31 to 38%. And if you look at what's happened to purchasing power in Texas, if you take the median household, um, and you say, okay, We're going to take the median household income and we're going to talk about a 90% LTV. And when you compare purchasing power at a 2.96% mortgage like we had in 2021 to what is it now? Around 5.8%
Mm-hmm.
right now.
Mm-hmm.
The median household in Texas has lost $72,000 of purchasing power, or that's about 25.6% decline in purchasing power from last year up until now. And so when buyers don't have that purchasing power has fallen pretty close, it's getting close to that normal range. And when buyers don't have the purchasing power, I don't see how home prices can stay where they are. Eventually, sellers are going to have to capitulate and start, dropping prices to get to where buyers can afford at the current mortgage rates. And so, what does it mean long term for the people who've bought at the top of the market? A
Mm-hmm.
lot of that depends on how committed the Federal Reserve is to killing consumer price inflation. If they're committed to it, home prices are going to fall, and in my opinion, I think quite significantly. But the problem then is that the real estate collateral values for banks starts to fall, and you get stress in the banking system. And I think what could happen is the Federal Reserve could panic and reverse and start quantitative easing again and pumping more money back into the housing market to support home prices. Does that mean prices are going to go back up? I don't know. Is it going
Mm-hmm.
to? But then we're going to still have the problem with inflation. So the Fed is really in a box. Do you want to kill inflation, or can you handle falling home prices? And so I don't have the answer to that question today, but I hope people can see that we're really in a box here between prices and home inflation and home prices. So
Okay. Thank you, Gerald. There's a lot of great conversation going on in the chat right now. People making different comparisons. For example, the difference in somebody said that was the industry, the energy industry was booming back then. It's not now. Now we have a lot of investors in the market. There was even a comment here that I wanted to bring up and see if you can help us with this answer. Evan says he's appreciating the analysis, but he's asking, are we considering the lack of housing inventory now compared to the 70s or early 2000s? So,
okay, those are fantastic questions. So I just want that comment about the energy industry not booming right now.
mhm,
Um, is fantastic observation, because in 2008, one of the things that really, and 2009, 2010, that really helped Texas was the boom in energy and the boom in fracking.
mhm,
What that caused was a lot of people, unemployed folks from around the country, started moving to Texas and created demand for housing, and grew our jobs and really helped Texas recover in a hurry. Well, not only do we not have an energy boom this time, but we've got a political and regulatory environment that wants to kill investment in hydrocarbon, in energy, and it's going to be a significant headwind. Um, let's talk about another headwind, or another thing that's not in place that helped the housing market back in 2000 and 2008 is falling mortgage rates,
mhm,
and the Fed dropping the Fed funds rate by over 500 basis points. That was a tremendous boost for the housing market, both in 2000 and 2008. And so people in Texas who were benefiting from the energy sector had more income to spend, and lower mortgage rates, that they could spend more and
mhm.
buy a house. So that really supported Texas housing prices in 2000 and 2008. So what's the difference today? No support from the energy sector, Federal Reserve raising Fed funds, and mortgage rates spiking. So this time really is different than those last two times. Now let's talk about the supply and the
Mm-hmm.
lack of supply. Um, and actually, I was going to touch on this a little bit in the outlook.
Mm-hmm.
We could maybe table that to
Mm-hmm.
and talk about that in the outlook. But I have some significant concerns about potential for some significant increase in supply.
Okay, yeah,
Um,
we'll get to that in a little bit then, because towards the end, I want Gerald to share his outlook for the remainder of 2022 and into 2023. Um, let's keep moving here. As a data research scientist in real estate, it's obvious you analyze trends. That's what you've been showing us are the trends. What trends are you seeing lately, specifically in Houston, but also in the state of Texas?
Okay, so I just have been putting together some new data sets that talk about price increases and decreases, that talk about so, and also so I can look at the new listings coming into the market, and also what the composition is of the active listings in the market, right? This is all stuff that happens before the sale, right?
Mm-hmm.
We get a lot of statistics based on sales, but that's really a lagging indicator, right? You have to look at, first of all, what's happening in price increases and decreases. So let's take a look at that. What's going
Mm-hmm.
on here? And see, okay, here we go. So this is Houston listings, and this is price changes. The blue line is the decreases, and this is for the analysis I'm going to talk about here in the next little bit is just dealing with single family existing homes. So the blue line is the number of price decreases each month in on listings, and the orange is the number of price increases. So I'm counting the number of price increases and decreases, and you can see it's very cyclical. You can see in 2020 and 21, the number of decreases fell significantly and the number of increases increased significantly. Well, if you look at, there's a lot of cyclicality. So let's take a look at the year over year trend. Okay, next slide. So this is the year over year trend. Now you can see that on the blue line, in the last slide, there was an uptick in the number of price decreases.
Mm-hmm.
But when you look at it on a year-over-year basis, it's not that far out of line compared to what it has been in prior years. When you look at the number of price increases, well, that party's over, right? That ship has sailed. There is a shrinking number of price increases, but a fairly reasonable normal number of decreases for this time of the year.
Mm-hmm.
But let's take a look at what's going on around the state. Sorry. So one more. This is an interesting one. This is looking at the median price change. So of those price changes, what's the median amount of the change? And you can see that in Houston, it runs around $10,000. So realtors have a real target in mind when they start dropping prices. And we can see we've reached the peak in price increases at just over about $15,000. So I think you're going to see that start working its way down. But
Mm-hmm.
let's take a look at what's going on around the state. Okay. Now we said Houston, the price decreases were not that far out of line for this time of the year. Starting to dip a little bit, they're not that far away. But look at what's going on in Austin and Dallas and San Antonio. The year-over-year spike in price decreases. Okay, I'm really concerned about what's going on with the number of decreases in around the state. And while it's not in Houston today, I can't see how it doesn't get here eventually. Um, but and when you look at the increases, the number of increases on the next slide. Okay, there we go. okay, that ship has sailed around the entire state, right? For the major metros. So I'm concerned right now that those decreases, and when you look at, um, especially in the Austin area, it's in the outlying areas, the number of price decreases. And and so I'm starting to wonder, number one, if this, the housing market is really softening, and these decreases are a leading indicator or precursor to falling prices. um, and also concerned about price decreases in outlying areas. Are people getting tired? There are some folks that are working remotely, but there's a lot of folks that are still driving. And I'm wondering if the price of gas could eventually start um, hurting the home values of homes in the outlying areas. So that, okay. Was there
Oh,
any?
yeah, I was going to say, well, with that in mind, are there any particular parts of the Houston area or price points that are doing better or worse than others currently?
I haven't been digging into the price points right now because things are changing so fast. Houston has not experienced, I think, any significant price declines overall. One thing that caught my attention last week was this spike in new listings in Montgomery County. Uh, I'm wondering, is there something, and in the outlying, there was a real increase in new listings in the outlying counties around the MSA. Harris County was pretty steady, and so I'm starting to wonder if the outlying areas around Houston are being impacted. I didn't get an opportunity to look at price increases and decreases in the outlying counties, but that's what we're going to start seeing first before we see price changes. So
Okay. So there was a
that's for a future
for,
session.
yeah, absolutely. There was a comment. Stephen just made a comment that the current statistics show homes in Houston are still selling over list price. But as you just said, you see that too, but you do have some concerns.
Excellent. Okay, so let's talk about new listings and um, active listings. Okay, because this is something where I think and I haven't, those that price over, the sale price over list is dominant in the higher price cohorts. Okay, so you look. So this is, I don't have charts for this, but one thing I noticed across the major MSAs, and this is, I mentioned to you, I was looking at it last night and this morning, but the fastest increase of new listings is over $500,000. The supply of new listings at the lower price cohorts is falling significantly, and the supply of new listings over 500,000 is increasing significantly on a year-over-year basis. And I'm starting to wonder, why do folks with homes worth more than $500,000 all of a sudden feel the urge to start selling their home, to start selling and listing their homes? Okay, and when I looked at, and that's now, that was a trend. That's a trend. That 500 to a million, the year over year spike in new listings that's really contributing to that flow is common in Houston and Austin and Dallas. Now, it's also in San Antonio, but there the price points, the spike starts a little bit lower, around 400,000. When I looked at the active listings, the median list price of active listings is a pretty flat in Houston, but I'm getting concerned about the decrease in the active listing prices in Austin, Dallas. It was up slightly, but it turned down in June, and in San Antonio, it's up slightly, but it turned down in May. So what you're starting to see is the median price of active listings is starting to fall. It hadn't hit Houston yet, but Houston seems to be holding up better than the others. But that doesn't mean it can't reach here soon. Now, remember at the start, I talked a little bit about securities lending
Mm-hmm.
and lending securities or borrowing cash against securities. There was an article that came out on Saturday in the Wall Street Journal that talked about wealth management, the wealth management business at Morgan Stanley and B of A. Wealthy clients are taking out mortgages and loans backed by their assets like stock and bond portfolios. Okay? They're using their stock and bond portfolios, and I'm sure for some they're crypto. They have been using in these last couple of years these significant increase in asset values in stock and crypto to take out mortgages. Morgan Stanley reported mortgages were up 30% in mortgages against stocks and bonds, that were backed by stocks and bonds. For B of A, it was up 12% to 222 billion. The wealthy folks are using securities-backed credit lines to scoop up assets on the cheap. Okay, I'm starting to wonder in these last 2 years, were there a lot of folks that maybe didn't have a huge amount of wealth but had recent wealth gains from stock prices in crypto? Did they use their wealth management accounts to take out mortgages to buy high priced homes? And if now we've experienced this significant decline in crypto and stocks, are these clients, these formerly wealthy clients, starting to get margin calls from their wealth managers and starting to get calls for cash? And are these folks having to suddenly start to list their 500,000 to $1 million homes? And could that be flushing out supply in the higher price points into the market? I don't know. I would love to get the feedback from your
Mm.
client is or from your members. Is this something that they're seeing in their client base?
Yeah, a lot of them are saying,
So
wow, exactly. So maybe they are. And please let us know in the comments if this is something that you've heard from sellers.
and those folks, remember we had the adjustable rate mortgages back in 2008. Well, these mortgages that these folks are taking, a lot of them are variable rate. These wealth management mortgages are variable rate. So when you talk about declining stock and crypto values, and now all
Mm-hmm.
of a sudden their variable rate starts adjusting upward,
Mm-hmm.
if these folks don't have a deep wealth base, there's a lot of these newfound rich folks that hit it big in the crypto and stock surge in the last 2 years
Mm-hmm.
are going to start facing some financial challenges. And I'm wondering if, we already know that the supply of homes below 500,000 is shrinking. People are sitting tight. They're not listing their homes. Okay, that's collapsing. But yet we've got this growth in high priced homes into the market. Is it, are we entering into a reckoning with these falling asset prices due to Fed tightening?
Okay.
So so that's something that to be aware of. And then for
Yes.
second home, oh, okay, um, and for second homes, right? A lot of that people were using it to buy second homes. Our second home's
Mm-hmm.
going to start coming back onto the market because of collateral calls in wealth accounts. So it's just something for your members to think about.
Absolutely. We have a few questions that I want to address, and we still want to hear your outlook for the rest of the year in 2023. But I wanted to touch on a few things that I've been seeing in the comments. Stephen was making comments about the pricing that we discussed in the beginning and how home prices got to where they are. And he was mentioning the cost of materials. The cost of materials tripled. Is there anything else you want to add to what we discussed earlier?
No, of course, there was supply shortages and costs tripled, but it may cost a builder, amount, 3 times the amount it costs to build a house because of supply shortages and
Mm-hmm.
cost increase. But buyers who don't have cash can't pay 3 times, and so while there was this increase in costs, there was also the fiscal monetary stimulus enabled the ability to pay.
Mm.
And when you have buyers able to pay and builders with the cost structure, prices just get higher. Now it's interesting. It'll be very interesting going forward. Lumber is falling. Home appliances prices are falling. They're not inflating. They're
Mm-hmm.
deflating. So there are some material costs that are falling for builders. So if builders can, in the near future, start building homes for less and selling them for less, maybe building smaller floor plans and selling
Mm.
at lower price points, what's that going to do for the person who just bought the existing home at a high price and they want to sell it, but they're competing at a builder who's now experiencing lower costs and is building a smaller floor plan so they can sell at a lower price? That's going to have an impact on prices in the existing market.
Okay. You mentioned the buyers that they had the cash, they could buy it, but as Andrea says here, about 30% of the homes that were purchased were by investors. And we're seeing a lot of comments about investors being the ones that are purchasing these homes. So, what are your thoughts there, and what would you like to add about investor purchases?
Okay. Investor purchases, and this feeds a little bit into the outlook.
Mm-hmm.
Okay, so let's talk a bit of outlook, and let's tackle the investor question at the
Yeah.
same time.
All right.
Okay, so uh, what's my outlook for 2022, 23? I believe, and I've been reading this and hearing from a lot of respected venture capitalists, that tech crash 2.0 has started. Okay, we're into a tech crash right now, and liquidity has been cut off to unprofitable tech companies. Okay, we've started to see in some of the prop tech firms in the real estate industry layoffs. Well, I think that's going to expand to many more technology companies as they're struggling to survive. They can't do any more IPOs or have any more cash. And so
Mm-hmm.
what I think is going to happen is the technology sector, and I think it's going to start happening before the end of the year, is we're going to start to see more and more layoffs. There's also a liquidity crunch in what I call the subprime corporate market, right? Weak corporates who all of a sudden, they borrow at junk bond rates. The cost of their debt is going up, and they're going to have some real difficulty refinancing. And so, what I see potentially happening there is just like in the tech business, these more traditional companies that are trading at subprime at high yield rates could potentially be facing layoffs. Of course, I think what's going to happen is liquidity in the housing market is going to continue to dry up. There may be new supply coming into the market, but that doesn't mean there's going to be new buyers coming into the market just because they can't afford. Um, so, what's going to happen? Uh, Another thing, and this feeds into the investor purchases. For 40 years now, and particularly in the last 2 years, mortgage rates, treasury rates, and mortgage rates have been falling, which has been increasing purchasing power significantly. You can pay a lot more for a house at a 2.96% mortgage than you can at a 13% mortgage. And just naturally, that causes home prices to rise.
Mm-hmm.
What we've got now going forward, mortgage rates aren't going to fall another 10%. And what's going to happen when investors, all these folks buying these single family rentals, the institutions, all of a sudden find out that there's no more price appreciation left in your returns. Okay, because mortgage rates aren't going down. And the Federal Reserve, have you heard of a thing called quantitative tightening? The term quantitative tightening, where the Federal Reserve is going to start selling treasuries and mortgage backed securities. In order to sell those, they're going to have to offer very high yields, maybe very high yields on treasuries and mortgage backed securities. These institutions that have been buying physical single family properties are all of a sudden going to be faced with a choice. Do we want to continue to operate single family properties that aren't going to experience price appreciation and actually may have depreciation? Or buy very high yielding assets, almost like distressed assets, from the Federal Reserve, having to sell at very high yields? I think quite possibly, and this is a risk that I see for the housing market, is institutions are going to lose their appetite for single family rentals because home price appreciation for the next 5 and 10 years is not going to be anywhere close to what it was. They're going to start dumping single family homes back into the market and going and buying these high yield, highly discounted securities the Fed is going to have to sell to reduce its balance sheet. So I think quite possibly in the next couple of years, you could start seeing institutions changing their mind. They don't buy at market prices, they buy above market prices. And they don't sell at market prices, they sell below market prices. And so that is a risk that I see solving the supply problem and exacerbating downward pressure on single family prices. I hate to be the downer, but I will leave you with one potential upside. Europe is looking for a lot of natural gas right now. And I'm hoping maybe that attitudes in this country will change and we'll have a regeneration of appetite for investment in industry and natural gas and energy in Texas, which could help soften the downside for the Houston market. But I'm sorry, but that's kind of, it's just we're in a new world. The Federal Reserve declared we are in a new world, and when liquidity declines, asset prices decline. It's not my opinion; it's just the way the numbers work.
Exactly. And that is what you do, analyze the numbers. And we truly appreciate you taking the time this morning to share this with us. As Monique said in the comments, we appreciate your knowledge, and we certainly do. So Gerald, again, thank you so much for your time. We have a lot of people thanking you in the comments. Is there anything else that you wanted to share with our members before we wrap up today?
I just wish them the best, and even in down markets, people with good skills and good integrity are in demand. So maybe the types of sales change, but the people with the best integrity and the best skills will always do the best. And so my best wishes to them.
Wonderful. Well, again, thank you so much, Gerald, for your time. Next Monday, I want to let everyone know we will be joined by HAR member CJ Johnson. She is with VA Rep, and she is going to let us know everything we need to know to help your veteran clients. So be sure to tune in next Monday at 9 a.m. for that. That is it for this Member Focused Monday. I hope you all have a wonderful week. Bye-bye.